Hello, everyone. Welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. This is episode 111 of the PetroNerds podcast, and I'm super pumped to give a short introduction to this podcast because this is the webinar that I did with the Liquid Energy Pipeline Association. So this has been in the queue for a while, but we've had a lot of things going on in the world. I've had a few presentations to give, and I've been on the road for a while, and we also had 4th of July. So this has been in the queue, but this is an awesome webinar. It's a great conversation. And this is with the Liquid Energy Pipeline Association, so LEPA. And this is with Andy Black, who is from the organization, and Tad True, who I've had on the podcast, who's a great friend and colleague. And just, it is a stellar and phenomenal podcast. So if you have not listen to the podcast with Tad True from True Companies. He's the vice president of Bridger Belfouche Pipelines. Please listen to it. But this episode is just awesome. This is everything on, this is a webinar that we did. And this is Andy and Tad asked me a lot of questions and we go back and forth. So it's really fun. This is really a podcast that's midstream focused, but it's production, it's pricing differentials, it's looking at thinking about the history of U.S. shale when we saw those major pricing differentials and the blowouts between West Texas Intermediate pricing and Brent pricing, and those big spreads that we had when we had $10, $12 global pricing spreads, and why that mattered for the midstream sector and what was happening. So it's an awesome look back. I really am super excited for you guys to hear it, and I'm really super excited for the feedback as well. So this was recorded on May 17th, 2024. So this was recorded a couple months ago. The reason I waited is because it's a very topical focused podcast. So it has aged well. Don't worry. But today is actually July 16th, 2024. So it's a couple months later, and actually prices are almost exactly the same. So we were $80 on May 17th, and we are at $80.75 today for WTI. We've really seen WTI in quite a bit of volatility. A lot of that is because of all the Fed rate volatility, and some of that has to do at least with the geopolitical volatility and the political volatility. So I am not going to get into politics within this podcast or within this introduction because there are going to be a lot of future podcasts. Within this past several weeks, a lot of things have changed. We had the debate between Biden and Trump, which really shifted the political sentiment and just the economic weight of the political sentiment and the economic bets within the stock market of who was actually going to be the president. And then we saw a lot of fallout with the Democratic Party. And then this past weekend, we saw an assassination attempt on Donald Trump. And that is this implication for this are really, really serious. He picked a vice president. He picked his pick for vice president, JD Vance. So there's just a lot of political fallout going on, and a lot of that is getting tested and baked into the stock market. So, but most importantly, what I've been doing in the past few weeks, and these will all be forthcoming podcasts. So there's a lot of really awesome stuff in the queue. The last couple of weeks we had the 4th of July holiday, so that's why we put a pause on the podcast. But last week I was in New Mexico, in Albuquerque, New Mexico, for the Independent Petroleum Association of New Mexico, their annual forum. I was the keynote speaker in the morning, and it was such a stellar conversation. The few days I was there with the operators and the people and the representatives and the politicians that were. So really, really great. I learned a ton, and the keynote speech went awesome. So I've recorded that, and that will be a forthcoming podcast, and that will get you absolutely up to speed on everything happening. But that did take place prior to this past weekend, which obviously was the attempted assassination on Donald Trump. So things have shifted since then, which we'll recap and get into. But with all that being said, expect a lot of volatility between now and the election. We were already expecting a lot of volatility, but I think you can say the risk for geopolitical tensions, the risk for oil price shifts are very, very high. And within these presentations, which will be forthcoming podcasts, I get in a lot to the Fed. I get in a lot to inflation, interest rates, and everything on that trajectory. So the week before that, I went home for the 4th of July holiday, which was awesome. You might have seen a LinkedIn post with that. And then the week prior to that, at the end of June, I saw Chris Wright and Toby Rice in Washington, D.C. I was with Mark Mills and team for the National Center for Energy Analytics. Those of us who are senior fellows attended a dinner, and they had a big energy forum, which Chris Wright and Toby Rice spoke at, which was a lot of fun. Former Senator Mary Landrieu also spoke at it. So a lot of heavy hitting folks. It was a really good dialogue. They recorded it, so you can tune in. But stay tuned because I'll be doing papers and lots of things with National Center for Energy Analytics. And then prior to that, I was actually in Boston just prior to that, and gave the keynote address on Friday at the AAPL, the American Association of Petroleum Landmen, which was also super awesome. Feedback is great, and the LinkedIn post was really, really cool. So with all that, and when I was in DC, I also gave a talk to the American Enterprise Institute, or AEI. So a lot has been there. These are going to be forthcoming podcasts. I'm really, really pumped to get them out there. But with this, I really hope you guys enjoy this. This is I love the midstream sector because it's obviously closely tied to the upstream, and you really need to know the upstream. And Tad and Andy are ask fantastic questions, and it's just a really, really great conversation. So with that, talk to you soon, folks. Bye.
Hey, welcome. This is Andy Black with the Liquid Energy Pipeline Association. So glad that you could join us. Liquid Energy Pipeline Association represents owners and operators of pipelines that are an important part in all of our lives. Our pipelines transport products we use all the time, like gasoline, diesel, jet fuel, and propane, from where they are produced to where we use them. We transport raw materials like crude oil and natural gas liquids from where they are brought out of the ground to where they can be turned into the products we all use. And low carbon, carbon dioxide is moved by pipeline from where it is captured to where it can be safely sequestered or used. We're so glad that you're here. We'll first bring in Tad True. Tad True is Vice President of Bridger Pipeline, part of the True Companies in Wyoming. And Tad has been on the board of directors of Liquid Energy Pipeline Association for a long time. He's current chair of our FERC Policy Committee. Tad, welcome.
Thank you.
And then we've got our guest, Trisha Curtis. Trisha is the president of PetroNerds, LLC, a consultancy in Colorado, and has been a great voice, a great watcher of what's happening in these markets, familiar to many of you. And for those of you who haven't gotten to know her, this is a great opportunity. Trisha, welcome.
Hey, thanks for having me. Pumped to be here.
Let's start. Talk about what's driving oil prices. I know this is something that you watch carefully, and there's a lot going on.
Yeah, there is. So we can keep it sort of brief, so we can dive into different segments. But I would say there's really sort of a push and pull on oil prices, and I mean, certainly we're at very healthy levels at $79 and change. I mean, we're at $79.64 right now, a little over $83 Brent. And you have multiple factors that are very much keeping oil prices up, and that is a lot of geopolitical angst, multiple hot wars, and just extreme volatility, I think, on the geopolitical side, where you have significant tensions with China, which is one, but you have an ongoing war with Ukraine. And in fact, you've had a turn where I think Russia's actually getting a little more comfortable in this much longer term war. So that keeps a geopolitical risk premium on oil. And then you have the war between Gaza, or Hamas and Israel, and then all these proxies, Hamas, Houthis, especially the Houthis in the Red Sea and the Indian Ocean attacking ships. And so all that keeps oil prices elevated. The news, you can be careful if you're watching the stock market because it's very news driven. So every week you get a new headline that, people are feeling less comfortable or more comfortable about China demand, or not comfortable about China demand, or they think there's going to be a ceasefire in Gaza, and that moves oil prices down. But that's sort of the push to keep oil prices up, is all that geopolitical risk premium. The pull to keep it, before, getting out, going crazy and really pushing into the hundreds, or even I would say even 90, is the fact that we have a lot of spare capacity. So the U.S. is producing over 13 million barrels per day, and we've done that consistently now for several months. We dipped in January, but we're back above 13 million barrels a day in February. Very, very impressive feat for the last 5 months of 2023 to be producing over 13 million barrels per day. And so if you just think about that, that's a lot of crude oil. That's 13% of the global market. But we also have Russia producing nearly 11 million barrels per day, and we have the Saudis who are producing about 9 million barrels a day. And what that really means is you have a lot of spare capacity within OPEC, particularly within Saudi Arabia. So if the market really needed the Saudis to bring 3 million barrels a day online, they could do it pretty easily and pretty quickly. And that is something that sort of keeps oil prices capped. Now, how well the average trader who's moving this $5 on these $5 swings knows all this and is following all this intimately, that's another question. But that's the rough sort of gist of the push and pull in oil prices right now. And I would say there are, we have concerns within the Chinese economy. I mean, serious concerns. It's not a great economy, but there is a difference between the consumer who's suffering in China and not doing well, and sort of the industry, which is very much kind of on a war footing supporting Russia, which is doing okay. And they're stockpiling a lot of crude oil, so that keeps crude stockpiles elevated. And in the U.S., we are maintaining this economic growth, and we're maintaining spending, but that lasts as long as it lasts until the shoe drops. And so we do have some decent softness on the diesel side, where you see a lot of weakness on the diesel front actually in the U.S., and you have gasoline pretty steady, but you're not seeing massive growth. So right now it's sort of steady as you go, and like everything in the market, you just have to follow the data very, very closely.
So what's the signal for production of crude oil, right? These are midstream operators that are moving the oil and gas liquids as these are developed. What would you expect?
Yeah, so I mean, on the midstream side, things are good. Things are full in the Permian, so it depends on where you're at. If you're in the Rockies, it's a little bit of a different story because of how things have unfolded since COVID. I mean, this is not the world we were in 2019. We've had a completely different world, 2019 to now. But I mean, the signals are, as long as prices are 79 and change, as long as you have these healthy, I would say north of $60 oil prices, you're going to see continued production growth. Last year was a very unique year in the business. If you were on the service sector, kind of like myself, you really felt a material pullback in spending by operators and across the board of spending of everything. And, oil companies it was $80 oil, but they were spending like it was 60. And there's a lot of folks that will echo that. So that doesn't mean that folks were not drilling and completing wells, but what you are seeing is that, 13 million barrels a day, what's very hard for a lot of folks to understand is that we have a materially lower rig count. I mean, substantially lower than we had pre-COVID, and yet we're producing more crude oil than we were pre-COVID. So we're doing it with a lot less rigs. We're now at a new plateaued low where rigs had come off COVID, came back, and then they dropped back down, and we're now at this sort of plateaued low. And these rigs are just crushing it. They're doing a lot more with a lot less, and they're extremely efficient. And we're seeing a lot of longer laterals. So longer laterals means, and really efficient rigs means you need less wells. And we are seeing that. You are seeing less wells. So that is great for the operator in terms of a lot of resiliency. And it really, from a midstream perspective, it's good as well. The midstream side it's one of those realities that you have to have the pipeline capacity and you have to have the midstream in order to give the go signal for production. So we don't want to get in a situation where we were in 2010 to 2012 to 2013 where things were really, really tight, because that's when differentials blow out, and that's when we start seeing a slowdown in that activity. So right now, especially in the Rockies, because you've had so many public operators that shifted into the Permian, and because you had so much acreage held by production, especially in North Dakota, folks were able to really reorient their capital to the Permian. But now you're seeing, the Bakken's doing incredible. The decline rates are really, really good. The productivity is excellent. This is a well-known rock, and it's excellent. So, I think we'll be getting into a little bit of that later, more with Tad. But I think what you're looking for, if you're on the midstream side, is maintenance, is how do oil companies feel about oil prices? Are they continually drilling? Are they going to grow production? And are we going to continue to see, growth output of that 13 million barrels a day incrementally grow? And right now, I think, unless you're seeing material low oil prices.
Big picture for a moment. While oil prices have been higher, natural gas prices, of course, have been lower. What are you seeing there? What do you expect?
Yeah, so natural gas prices have come up substantially in the past week or so. We're at 260. So if you were at one and change the other, a few weeks ago, in the Marcellus, it's extremely painful because you're barely getting a buck. If that, you're probably getting less than a buck for your gas. And in the Permian, you were saying negative Waha Permian price on gas. So we are in a very, very unique spot with these really, really lower natural gas prices, very, very high crude oil prices. You have high natural gas liquids prices, and that's positive for oil. That's actually quite positive for gas in many ways in these gas plays, because even where natural gas is hurting you on the margins, you've got the natural gas liquids pulling up. That means you're going to go after condensates. That means you can go after the liquids rich area of the gas plays. That means you're going to, the Eagle Ford's going to do well. And from a throughput standpoint and a midstream standpoint, that's all good. When you have too much gas, we need more. We absolutely we'll never not need more gas pipelines. I mean, that's a really serious thing. We're going to need a lot more because unless you're going to crater oil prices and for a long period of time, you're not going to see gas production drop. And even then, you're going to hit the bubble point in the reservoir, and those older wells are going to grow gas production. So, we're at about 129 billion cubic feet per day for natural gas production, more than double the second largest producer in the world, which is Russia. And we have way too much of it. And so we need to be able to we need more internal pipeline capacity, internal infrastructure. We need more gas processing, and we need to be able to export more. But gas is the midstream problem that is never going to go away. And I would say, there's a lot of scenarios we can map out where actually you do need more pipe. You're going to need more oil pipeline capacity in the Permian, and there's scenarios where you might need more oil pipeline capacity, certainly in the Rockies. But right now, we're okay there.
Well, let's get into more detailed questions. I'll bring Tad in, and for viewers, you'll have the opportunity to author questions in the chat. We'll see those. We'll try to sift through those and get as many of those as we can asked. Tad, over to you.
Excuse me. Thank you, Andy. Good morning, Trisha. It's still morning for us here in Mountain Time. When we talked, we kind of agreed that we'd keep it mostly free form, and I think that would be more instead of structured, and see where this thing goes. So we met 12 years ago, and we had the discussion about like whether it's 10 years or 15 years. I think we compromised on 2012. And I was thinking about that. I was like, and the reason we met was we were going through, and we were on the speaker circuit, if you will.
Yep.
But because everything was completely the wild west. I mean, at the time, though, I was looking back at this, and at the time, production was 6.5 million barrels a day. The Bakken was only at 770,000 barrels a day. DJ Basin was just over 135,000 barrels a day. Keystone XL it's just started in its regulatory limbo. The Brent TI differential was over $15.
Yeah.
An average for that year. And crude by rail became the only way to transport all this new shale volume. And in fact, it actually became the preferred method of transport, so they, so like stranded barrels could get to the Gulf or get to whatever, wherever the premium markets were. In fact, we were running scenarios back then. I do this quite a bit. This is a paranoia of mine. It's like, what if the world just stays this way? And so we were running scenarios where, what if pipelines were no longer needed, and crude by rail was just going to be the most become permanent. Now the world looks completely different. We have Pony Express, we have Saddlehorn, we have Dakota Access, the Reversal Seaway, Market Link, Cactus Gray Oak, Bayou Bridge, et cetera, et cetera, et cetera. And even a guy from Casper, Wyoming, knows what a VLCC is because of the lifting of the export ban. So here's my question for you: is in baseball terms, what inning are we in in the shale revolution? Are we in the beginning? Still in the beginning? Does it still have a ways to go? What inning are we in, and what do we have to look forward to in the future?
Well, so I think that's a really nice recap of our history of meeting. Man, it was crazy back then, because those differentials were ripping, and nobody understood. And shale was so much in its infancy. So when I was in Washington D.C., nobody understood what was going on. People did not have the correct numbers for what was coming out of North Dakota, and they didn't appreciate that. Pipelines were fighting for capacity, right? This North Dakota crude was coming online with Canadian oil sands, and it couldn't get down to Cushing. It couldn't get anywhere. So it was a really crazy time. And, it's very interesting because I just did a very short paper for the Oxford Institute for Energy Studies on shale, just kind of a recap of, 2,500 words, where are we at in the U.S. shale story. And so it's had me thinking about this and relooking at this. And I've been increasingly talking to a lot of operators and a lot of CEOs. And, if you're talking to some of the older folks in this arena, I would say that they will tell you we're later in the story. We're later in the innings. And some of them might, be a little bit different, but I would say increasingly that's what I hear from folks, is that we're later in the innings. I don't think so. And that's because I cut my teeth on this, and because, as I'm doing it, the differentials are blowing out. And, the Bakken is the oldest unconventional, play we have in the world now. So it's great. The rock's awesome. It's this, Oreo cookie formation. You don't drill a dry hole. I mean, you actually never did drill a dry hole in the beginning. You may not have gotten a 3,000 barrel a day partial field EOG well that everybody loves. But you didn't drill a dry hole. And so we've changed a lot in terms of even, think 5 years ago, what was feasible and what's feasible, what was not feasible 5 years ago and what's feasible today. And even in North Dakota, I would think, multiple benches of the Three Forks were, that was exciting and interesting, but people weren't doing it in earnest. And now people are very, very comfortable at Three Forks. They're very, very comfortable about drilling deeper. They're actually, we've always drilled 10,000 foot laterals in North Dakota, but now we are drilling longer laterals. And so the really great rock, when I think you think about the innings, you have to think about how much are we getting out of the rock? And it's still under 10%. So the actual recovery that we're getting from production is under 10%. So do we have a lot more oil to get? Absolutely. Now, in the innings, people always look at this, and when you talk to folks, whether they're outside of the U.S. or they're in New York, I always say the further you get from the oil patch, the less information you have and the more removed it gets, and it's very easy to be skeptical. So certainly it would be hard if you don't know much about U.S. shale. If you're looking at the rig count, you're going, how the hell is this happening? How are they producing 13 million barrels a day with this rig count? And that's because that, yes, we have longer laterals, and yes, we have more efficient rigs, but we also have a substantially increased knowledge of the rock. That every year, especially when we have a downturn, and 2020 did that, when you push this industry to do better, it responds. And so that incremental knowledge of the rock and the ability to keep that that drill bit in zone, when you're doing that a little bit better, you're fracking better, right? You're fracking more in zone. So that completion is going to be getting more oil. And I think that's the real different story of where I probably have a different view than a lot of folks, is that people think we've drilled up the core, and you can dispel that pretty quickly because you can look at where public operators are drilling, where their permits are, where their wells that they've drilled but haven't completed are, and you can look at where the privates are. And private companies are completely outside of the core, right? They're not where the publics are. And so they've stepped out, and they've really, if they've stepped out and we're bringing all this production online, if my decline curve is not getting smashed on a normalized basis, then I'm not losing a lot of production, even as I have private operators stepping out of the core, even as I have longer laterals, all these things. And so these wells are holding up, and that's partly because the service companies have done such a great job, and we're doing better with the rock we have. But that also tells you that a few years ago people would have said we're at the seventh inning, or we're nearing the end of the game. And I would say it's more like we're maybe toward the end of the innings, but I've been to a Rockies game where there was 18 innings in college. So, maybe it's one of those games where you just keep on playing. And I think that's where it keeps, every time there's an extra inning, people get surprised the upside. And I think U.S. shale is going to continue to do that.
Okay, so you mentioned fracking within zone and that type of thing. What other compare the way they're drilling now to the way they were drilling in 2012. Okay, do you have any specifics about that?
Yeah, well, it's night and day. I was thinking back to when I actually met, I believe I had dinner with Tim Dove and Scott Sheffield with Pioneer Natural Resources. And it was, a lot of people didn't know this company, but they were spending a lot of time in DC in 2012 because they were lobbying along with Carroll Ham and Continental, were lobbying for crude oil exports because everybody desperately wanted to export this crude with this differential. And it was smart. But I remember having dinner with them, and I was talking about, when are we going to see these horizontals in earnest? Because Pioneer Natural Resources, people forget that they were drilling these verticals in the Permian Basin in 2012. Still drilling verticals. They were $1 million, but they were drilling vertically in stacked pay and doing these multi-single fracs in these stacked pay zones. So if you think that was just 2012 to now, you are drilling, on a continual basis, these companies are drilling 3 mile to 4 mile long laterals and completing them effectively, which is that very end. If you sit where you're sitting here and you think 4 miles out, that is a long distance, and you are fracking all the way at the end of that. And only in the past, I would say, few years have drillers got comfortable with pushing that to drill all that far, but really not because they couldn't get the drill bit there, but because they were concerned about, can we effectively complete the toe of that well? And now they are effectively completing the toe of that well. And that's really, really impressive. I would say, in 2012, crap, when they were just starting those longer laterals, especially think about the Delaware Basin when EOG and companies are just starting in New Mexico, and it's deep and it's hot and it's thermally mature and it's 13,000 foot deep. I mean, that depth scared a lot of people, and EOG is just crushing it. They're just, let's go down there, let's do it. And some of these wells took, they could spud to TD super fast in North Dakota, but when they come down to New Mexico, this has taken them, some of these companies, a month. And even a few years ago, people were talking about a 3 mile long lateral would take somebody a month. Now I'm hearing spud to TD for a well for a 3 mile long lateral in 10 days in like the Midland Basin, and spud to TD for a 2.5 mile long lateral in 8 days. That's such an incredible difference in change. And people will say, yes, maybe we're nearing the edge of those efficiency gains. Maybe we are, but that doesn't mean there's a million other efficiencies within that we can talk about. But every time I talk to operators and every time I talk to folks in the field, it gets a little bit better all the time.
Okay, that's fascinating. What it made me think about is we actually, one of our affiliate companies we have a contract drilling company. Okay? Mm-hmm. And one of the things I remember they drilled into the Bakken, and it was one of their first horizontal. It was their first horizontal shale. You look at the profile of the rig going through basically they're supposed to go through this flat, Bakken, and the drill bit just went all over.
Yep.
So I think that was back in like 2013, 2014. So clearly they've gotten, that type of thing, keeping within zone, fracking within zone is
and I think not just in zone, but it's that they're more comfortable. They know, and that grows, right? They're more comfortable knowing what's in zone, what they want, where they want to be, where those fracks are going in theory, and getting more out. And so every day, every quarter, every year, these companies are getting better at knowing that rock a little bit better and extracting more. And I would say even now, conversations I have with operators on, where they've landed that horizontal, where they fracked, where they're doing, they know the rock a little bit better. So where they said, well, we didn't think we could land it there before, we didn't think we were going to get production, and then they did. And that's stuff that, a lot of the sort of shale skeptics, a lot of folks looking at this would say, yeah, that's not going to work. And that helps dispel and disprove a lot of, hey, the inventory question, which I think you should ask about, is the inventory question and, the core acreage and how much do we have left, and because people are super paranoid about that.
Yes.
Oh, yes. Okay. So I love it because it's like, what inning are we in? And then the tiers, right? And how many tier are the core acreage? And we're going to run out of this core acreage. And how many 6 do we have left to drill? And, there's only so much there. And certainly if you are looking at a map, and if I'm a midstream company, you're absolutely looking at that, right? You guys are looking at the data points. You're looking at the rig count, and you're probably looking at laterals on a map. I call them sticks on a map. And I would encourage folks, when they're looking at those sticks on a map, you have to be very careful, because if you're looking at the Permian, you're looking at like, holy crap, there's a lot of sticks here. But you have to sort of put your brain into the rock and start thinking that 4 miles out for the drill bit, and also start thinking, I'm 2 miles down and I'm in stacked pay and I'm wine racking this. And I'm trying to figure out, the operator is less worried about how many wells they have left to drill, and more worried about, how do I maximize the production, and how do I drill these effectively and maximize to where I have to then move over and drill and complete these, and I don't want to lose too much recovery. So that's more of the game. But also, if you go out to Midland, go stand in the middle of the field and ask the folks that are drilling if they're concerned about how much is left. And you really appreciate that there's a lot there. And the more this knowledge grows, and the more these folks become comfortable, you're able to do things that we thought we couldn't do at lower prices. Think about the Powder River Basin. A lot of that wasn't economic at $60 oil. Now we've had a downturn, and now a lot of it's going to be economic at $60 oil. So that happens in every place. So there's a lot of stuff, I think, in the Permian that wasn't gettable, and now we're thinking it's gettable. So we're talking, we've got tens of thousands of wells left to drill. Probably a lot more.
Okay, that's awesome. Okay, so I'm getting the sense that when I hear a lot of the headlines about the Bakken being mature, I don't know what that means. Maybe you can explain what that means to me. Do you agree, disagree? But I'm getting the sense you would disagree.
And do it with some caveats. I think the Bakken is the oldest unconventional oil play. We have drilled a lot of wells, and because we drilled them early on with knowing less, we probably didn't complete them properly. So I would say it's mature in a lot of respects in that, yes, you're going to have to be more creative in, you're not just going to get this brand new virgin acreage and just be able to drill a gazillion wells and it's going to be awesome. However, it is amazing to me how many folks, especially during COVID and even pre-COVID, how many 3-man, 4-man engineering teams I heard that were trying to get acreage in the Bakken. I mean, there were dozens of them, and they couldn't get it. They were trying to get Hess or Continental or somebody to give them just something that they had on the side, right? Some old production. And the reason they wanted that old production was because, one, they thought they could breathe new life into it. Two, they thought they could put wells closer together or by it, or like infill drilling. And so I think we really, it's hard for folks, to think about infill drilling of, okay, well, you're going to deplete those wells, and does that actually work? Well, as technology gets better, as we understand the rock better, as we grow our knowledge, we can. So I think you have to be, even if you couldn't today, in a few years, will you be able to do it better? 100%. So the infill drilling thing, I think, is real. More of the Three Forks in certain areas. I'm not saying everywhere. So it's definitely mature, but I think refracs are going to happen in the Bakken. They were happening, as you know, they were happening in 2014. Everybody was sort of testing them. And that's because, one, they didn't know how many sticks there were left to drill, and our knowledge was less. But they were looking great in the Bakken. And then the oil prices correct, and then the market reshifts, and everybody goes to the Permian, and we sort of lost this love for refracs. And the reason we lost the love for refracs is because we have so many wells left to drill. And so as folks look at the play differently and they start reorienting on their wells, like, you're not going to see refracs in earnest anywhere until they think, hey, we've really hit this inventory question. And then you're going to see where you're basically just putting new, a good well is a good well is a good well. So crappy wells won't work well, but good wells will. And I really, I think about the Bakken, and I've told you this before, but I mean, I think about these older wells that, were 4,000 feet and they crushed it. I mean, they just came online. You didn't need artificial lift for a long time, and they were producing a few thousand barrels a day. I mean, think about going into refrac those. And those were crappy fracs. Those were simple completions, and we'd have much more sophisticated fracs. We pump as much as 3,000 pounds of sand per lateral foot now. I mean, we pumped a fraction of that back then. So absolutely, I think it's mature, but it's got a lot of there's a lot of juice left in the tank.
Okay, well, so we just looked at a system in Colorado, where you're from, beautiful state.
I'm from Wyoming, Tad. I live in Colorado.
Fair enough. All right, we'll take that. You live in Colorado.
Yep.
Undeniable. We were looking at a system there, and one of the biggest objections we had internally was the regulatory environment. We just didn't know which way it was going to go, and primarily how is that going to impact the total supply that when you look at a new system, you're like, how much oil is going to go? We're not petroleum engineers, we're not geologists, so you kind of have to take a guess. But all of a sudden, you introduce this new uncertainty in the supply into your supply scenario. Talk about maybe the DJ Basin. Is it mature? Is the reason it's mature is it because of the regulatory environment? Is it like, just talk about the DJ Basin. What's the outlook for the DJ Basin? I mean,
yeah. No, I mean, it's good. And you should ask about Colorado regulatory. And it's not new. This has been with us, as you know, this has been for even pre-Jared Polis. And I'll be very honest. I mean, Jared Polis is no fan of the oil and gas industry, but, you sort of have to make deals with the devil. And I think that's where a lot of folks are at, is that recently, if you've followed anything within Colorado regulation, several oil and gas companies made a deal with Jared Polis directly to basically say, hey, let's take off ballots, let's take off these crazy ballot measures. And essentially, there was a bunch of crazy ballot measures that one side had, and so the oil industry came in and said, okay, we'll put a bunch of crazy ones. Jared Polis said, okay, let's just make a truce. Nothing's in writing. I wouldn't trust it. However, right now, there's kind of this truce that we're not going to ban oil and gas drilling. What's very interesting, and I think, so let's talk about Colorado, the reg side, and what it means in Colorado, because I think it's interesting from a refrac perspective, but then also put this in context of the Rockies, and sort of we can talk about Wyoming. I think that, so Colorado, we're producing, almost 500,000 barrels a day, which is very impressive. We're not back to these pre-COVID, back to the all-time highs. And, Colorado really struggled in production well before pre-COVID because of the regulatory shifts, right? Because of SB 181 that got passed that really changed the entire regulatory structure of permitting oil and gas wells in Colorado. But that being said, so you can see the decline in permitting, you can see the decline in production, but almost all the production is coming out of one county. It's coming out of Weld County. Weld County also handily defeated Proposition 112 in 2018. But then, the politics shifted and it became a very, very blue state. And Polis and the Senate passed this massive, huge thing on SB 181, which shifted the permitting. If you go down the rabbit hole and understand all that, it's more politically driven. It's just not business oriented now. But that being said, as prices now, you really saw this struggle throughout COVID. And then if you're looking at production now, production is coming back really in Weld County. Not because permitting is coming back, but because a lot of folks are the consolidation that we've had in the space. We've got massive consolidation, with Chevron. You've got Chevron, Oxy, and Civitas, basically these big companies that have purchased a lot. But all that near, let's say, 490,000 barrels a day in Weld County alone, several thousand wells, horizontal wells, really tells you when you talk to folks here, and the reason they like it is because they know the geology. It's sort of like, it's not the Middle East, but I always tell people it's a little bit like, why do companies participate in the Middle East? I mean, they have to have security crews and it's volatile and it's a mess, but the folks that know it, and they're very, very comfortable in this space and it's adaptable. And the folks in Colorado, I work with private operators, they know it really well. They love the phenomenal geology. It's easy to drill, it's pretty cheap, and you know what you're getting for production. So again, you don't drill dry hole. So it's great in that front. And that's what's helped keep, even with all the regulatory pressures and the permitting pressures, it's what helped keep things sustainable. And I think going forward, what you're going to see is, the question for midstream side is it going to grow? And I think from a production standpoint, it absolutely can. Right now, there's going to be a pause on the ballot measures. We just defeated a big bill that was you can find a Common Sense Institute paper on it, but there was a big bill to ban all drilling and production from 2030 onwards. That was defeated, but I would expect more of those to come. But refracking does get around that. So there are things that I think you will see the industry, they're going to go refract those wells. I think there's other things they can do with tinkering for production. So I think there's ways to, one, keep production up, but it's not a place I would look to do. For growth, you need investment. And for most folks, the regulatory environment it's too fearful to put the drill bit in the ground. Why would I want to put those dollars there? And quite frankly, the political environment it's so tenuous for a lot of folks that I think they're just going to look, they're more comfortable putting that drill bit elsewhere.
Okay, that's good. So in North Dakota, if I'm an operator, and if I'm thinking about this right, and I'm looking at the DJ versus Bakken, and looking to see what my supply is going to do to feed my pipeline. DJ, what they're focused on from just for regulatory ease is refracking, as you said. And is it correct to say that in Bakken they're still expanding their new pads,
Yep.
They're still drilling.
Yep. They still are, and it's because the cadence has slowed, and because of it's far more seasonal, as you know, and because people hold their acreage by production. I mean, there are trends that shifted within the Bakken several years ago as people held their acreage by production. They put money into the Permian Basin, so it is very seasonal. But because of that, you also have this more streamlined cadence, and so you just don't have. It's not like we have zero wells left to drill and we have to refrac. In Colorado, you could certainly see that environment where there's a forced situation, and I'm sure there could be regulations, but I really do think it's a opportunity that it's going to happen, and folks are going to start doing it, because especially if it gets around the permitting side.
Okay, so. And you partially answered this question, but I'm going to ask it anyway. So when I look at type curves, and then this is all about supply,
Yep.
From my standpoint. We're obsessed with people's type curves. We
Yep.
haircut their type curves. We think they're way too optimistic, but that's the role of the E&P guy. When I look at horizontal well type curves, they concern me as a pipeline operator. So where in the world is my supply going to come from? And so we always have a scenario out there. It's like, what happens if people just stop drilling? And in that scenario, after 1 year, half my volume just disappears just because of the factors. I mean, half the volume just goes away. Am I completely off the rocker here? Being that concerned about that?
No, I mean, so I've done work with you, Tad. I've worked with other midstream companies, and I love putting on different hats, because if you're a midstream company, yes, your answer to everything is that type curve is ridiculous. And quite frankly, in the DJ, if you're a midstream company, you saw curves that were absolutely ridiculous, where companies were never going to hit those. And you're in the Powder, you're in Wyoming, and there's no way in the Powder people hand you type curve and you're like, okay, like, yeah, you might get one well, but consistently you're going to give me 25 of those that are, every one of them is going to be hitting 2,000 barrels a day? No, it's a hard geologic play. So it's much harder from the midstream perspective. However, that's where this whole drilling longer laterals and getting more out, that's really hard too, right? Because if you're looking at previous type curves and you're saying, okay, this is what we're doing, everyone would have bet that we would be massively declined for productivity, right? That as you've stepped out of the acreage, as you've got privates that have stepped out, as you've expanded, as you're drilling more, as you're just, we're not in the core of the core that we knew, and we're not in the best of the rock. As we've expanded these plays and stepped out, you would expect those decline curves to really materially decline. And what's offset that is the longer laterals, is the increased knowledge of the rock, and is the role of the service companies to tinker with those completions and hold up that production. And I think that's just where you have to be very careful, is because as a midstream, you're always skeptical of the decline curve. And as an upstream guy, you're always mad at the midstream saying, oh my God, I told you how much we're going to produce and you didn't build the pipeline capacity to meet what I'm producing. And that's always the story. But it's always this push and pull, and it's hard for the midstream, because I would say the answer to all these problems is you have to overbuild, because if you want the play to actually succeed and to be there forever, you need to have excess pipeline capacity. And it sucks, because that doesn't work great on the pricing side.
You just made us all uncomfortable right there. You just made us all uncomfortable.
Don't be uncomfortable. It's the longevity of U.S. shale is really, really good, and it's beholden to. I mean, you guys are the ones that allow it to happen. Without the pipeline capacity, and truthfully, I say this, and I can say this from my job, and because I'm independent and different from you guys, is that without the excess pipeline capacity, and we can all be honest, we have excess pipeline capacity in the DJ. Without that, would you see the near 500,000 barrels a day you do today with the regulatory environment you do in Colorado? No way, not a first chance in hell. It is that excess pipeline capacity. It is all these redundancies in the system that allow it. And same thing goes for the Canadian oil sands. When you see production go up, same thing goes for all these places. It's what you see in North Dakota, what has allowed North Dakota to come back and move back. And so when you ask about like where is North Dakota for production, I mean, we knew we had pre-highs and we haven't hit those pre-highs. We could hit those again. So, I mean, it's an amazing it's a unique relationship that midstream and upstream has, and it's not an easy one, but you guys are sort of underappreciated, I think, in the world in terms of how needed it is, but I can say it's not going to.
I feel the same way.
Yeah, well, it's not going to go away. And in the Powder, you haven't asked about the Wyoming, and I love Wyoming, but and every geologist loves Wyoming too. But the fact that every geologist loves Wyoming is not the easy answer you want for a midstream company to just say you don't want this geologic love heart play, I heart geology, because they're like, oh, it's super hard and I got to crack this. Well, he's a midstream guy. You kind of hope they would have cracked this like 10 years ago and, we just have this consistency, and we're not there yet with the Powder.
The pipeline operator wants the producer to sign up, right?
Yep.
For long-term capacity. Talk about your conversations on that with producers. What's that perspective, and differentials change, and what are you seeing on differentials?
Firstly, I don't think the producer is concerned about the long-term production. You can split hairs in, a smaller operator maybe in the Powder where that's a bit of a question. But when you're talking across the Permian, North Dakota, even the Powder and the DJ, operators know what they're going to be producing. Albeit, they can, if they know what their laterals are, how many wells they're drilling, frac crews and everything, they know what they're producing. If there's an unforeseen price event, that can change, but they're pretty comfortable right now. This is not, we're in, because we're so far in the innings of this play, we're not worried about what we're producing. So that's had to have gotten a lot more comfortable than, 15, 12 years ago, 10 years ago, from the midstream side. On the differential side, it is a different story, right? We've seen when Tad's talking about that $15 differential, that was amazing. And we're nowhere near that, right? We've seen these differentials come in. The fact that we're at 79.64 for WTI and 83.61 Brent, we're at a we hang around this $5 differential with Brent. And part of that is because we have a lot of crude oil exports. We export about over 4 million barrels a day of crude, and that WTI crude is actually getting into the Brent contract. So there's the crude getting on the water, but also the crude getting into the Brent contract. So you have some of that. And that, obviously it's different from Guernsey, it's different from DJ, it's different from LLS. But I know a couple years ago, Tad, we were meeting, and there were premiums. You saw significant premiums basically outside of WTI. So you had a premium in Guernsey, you had a premium in North Dakota. And looking at some differentials, some of those have held up. And then when you get, obviously Canada blows out and the Gulf Coast doesn't look amazing. And so no longer, you have to move with the market. And I think we have to be a little bit careful of saying what doesn't look great today won't look good, in the future. Years ago, would you have thought that you didn't want to go to the Gulf Coast? Not necessarily. You would have thought, I definitely want to go to the Gulf Coast. So we have to be very conscious of supply and demand in the U.S., where the markets are moving. We lost a lot of refining capacity during COVID in California. And then we had lots of pains with refinery margins. We had a lot of pain on that front. We've since recovered a bit, but every time you have a refinery outage or a fire or something, we have problems there. And so that impacts a lot of this. And what is actual demand levels in the U.S., and those need to be sustained. But if demand softens in the U.S., but we have robust demand globally and we're exporting more crude, then all of a sudden, as long as you have the export capacity, then you're going to want to pull that to the Gulf. So I think we have to be very conscious of fundamentals and drivers. And I do think I don't think we're hitting an export capacity problem within the Gulf Coast by any means. But just like I say, I'm an advocate for more pipelines and your business to be robust, I am an advocate for more export capacity. You want more, especially for you guys if you have a pipeline on the lower 48, you want more export capacity because it just makes everything more viable. We absolutely need it on the natural gas front. We need it on the natural gas liquids front. We need more gas processing. We need to be export more natural gas, but we need to be able to continually export crude as the market demands it. We want to pull in more Canadian when we want it, especially when we have massive discounts. We want to process those at those complex refineries in the Gulf, and we want to be able to export this light sweet as we have it. And that allows these plays to flourish and thrive and your pipelines to be completely full.
Washington is catching up to the data center issue, right? Despite the fact that there are more data centers in the Washington area than anywhere else, people are recognizing now that demand for energy is not going to be going down. Demand for energy is going to be going up on that, and there's going to be a lot more gas needed to supply that electricity. Is that already baked in to everybody's expectations on production? What do you see? What do you think will be happening?
It's absolutely not. It's barely baked into anybody's thoughts on anything. If you can just sit here and think, how well does the oil and gas industry play or understand electricity? And I'm not saying people don't understand it, but it's not their market, right? It historically has not been their market. And now I would say every person in oil and gas, whether you touch gas or not, you need to get smart on electricity and savvy, because even if you touch crude, you touch natural gas. Right now, about 40% or half of our grid in the U.S. is natural gas powered. And then you have still a huge chunk that's coal, and you've got some nuclear that's flat, and then you have this rising wind and solar. That rising wind and solar is not stable. So in fact, I would argue that you have to have more natural gas. You would have probably less natural gas if you didn't have all that wind and solar, because you wouldn't need that increased base load. But the reality is these data centers, and let's put a big sort of evolving question mark on AI and data centers as well. Yes, those are going to grow, but you tell me the person who can articulate to me exactly how AI looks today, exactly what it does for everyone, and what it's going to look like 10 years from now. Nobody knows. The reality is we had the internet, we had the dot-com bubble and it bust, and we still have the internet. Looks a lot different than the dot-com bubble, but I would say the AI bubble is very, very real. You cannot have forward earnings trading at the multiples that, the multiples we have. That you can't have the whole stock market, running off NVIDIA. That doesn't mean NVIDIA is not viable and we're not going to need these chips. But I don't use ChatGPT. I don't need it to solve it can't solve the problems I'm trying to solve for. It can solve simple things, and that's going to evolve. Now, as long as we're sending, we'll increasingly send questions out, and those data centers are going to compute them. They need power. And so the bet is that, we will continue to send these questions out, and that they will have to compute this answer, and that computing power is what they're doing. Almost all of them are being built with natural gas-fired power generation. They're literally building, power generation, nat gas right there. And they're building 100% backup diesel generators for the backup. I mean, this is why tech, they can be lofty, they can be ambitious on energy transition and all the green BS, but they don't put their money where their mouth is because they need power. And so I think this is really where this is the rubber meets the road. When you need power and your business depends on it, you're going to build it. And so all these tech and AI entities, they're building out nat gas and diesel backup. And this, is also the realities of sort of the world that we see, is that we have this rising power demand. People would like to have, I don't hear anyone on tech saying we're building it with wind or solar. And the reality is, because you don't make things, you don't manufacture things, or they're not energy dense, they're not high energy dense forms of energy, so it doesn't work. And you certainly can't have the intermittency. So the cost is just too high. So it's going to be natural gas, and that means that right now we have enough natural gas, but you need the infrastructure, right? You need the pipelines. So you're going to have to be able to build more pipelines, and that means you're going to have shifts on the regulatory front. You're going to have, we have to actually be able to build pipelines. And I would say the industry has to be much, much louder about needing to build a pipeline. We can't just sit back and let this stuff happen, because the demand's going to be there, and it's going to be there when the prices are so high, if we haven't built one, that it's going to be horrible for the consumer and for the economy, and we won't be the prosperous country that we've been with these low energy prices.
So, Trisha, question about this. In speaking about electricity, and this is very pertinent to me, and I think the rest of the audience, is back in January, we had a normal North Dakota storm, minus 40, and I hate to call that normal, but as it turns out in North Dakota, that's what happens.
It is. It's normal.
So the power went out for 7 hours, and all the heat and insulated piping, at whether they're off, we had ended up freezing in that 7 hours, and broke a lot of infrastructure. That got me very interested in electricity, and I wanted to know why our power went. So anyway, we formed a group, met with the local power providers, and in fact, met with the actual utility itself. And it was very alarming. He reiterated a lot of things you shared about the electricity demand. And one of the things he did say is that if you come to me in 2027 and ask for a power hookup, you're going to have to wait for 3 years. That is going to stop any type of growth prospect that we have. Any type of new well hookup, or it's going to require us to generate our own electricity.
Yep.
And they admit that. They said we are running out of electricity. Where do we go?
So it's already, so to your point, it's already happening. And so you see companies like, you see a lot of companies that are doing their own off-grid power solutions. I ran into somebody just this week that was doing it. You see major frac companies are doing it themselves. Either they're contracting out, they're doing it. Liberty has their own LPI, Liberty Power Innovations, where they're basically doing their own stuff. And that's their electric frac, but it's all 100% natural gas. And part of it is, yes, that's where the demand is for electric frac from big companies who want to lower their emissions, but it's very efficient, right? And they're using all natural gas because they know they have the natural gas, and it also is solving this on-demand, power needs. So there are folks that are certainly investing. It's already happening. We know within the Permian Basin, we know within almost every basin, you could find an operator that says, I needed power when I can't get it, right? I need it infield. I need it for infield operations. Increasingly, the environmental push is I need you to frack. I need you to drill with electric, which is, yes, you can technically. I don't think it's the best thing to do necessarily. And I'm sure if you have power surges, that's a problem. But you can't really frack with it, right? You can't really just plug into the grid and frack because the power demand is too high. And then you have to actually power these wells. So in Colorado, with the green push and the red push, they're going to have to tie in to the grid. And that's sort of this real big problem we have in the world, is that the reality is that if you wanted to lower CO2 emissions and you wanted to go green, you have to electrify everything. Electrifying everything means you build out electricity. And guess what? Nobody in the world, including the biggest proponents of all this, are building out electricity. So power generation is actually declining in Europe, and power generation is incrementally increasing in the US, but it needs to increase significantly. Not regardless of where you stand on the green side, if you just want to keep your businesses going, you're going to need more power generation. And the trouble is, it's hard to build stuff. As you know, when they said, hey, you're not going to be able to get it, we have to increasingly build this stuff out. And so you have to be able to build a new natural gas-fired power plant. You have to be able to not put the coal one out of business. You need to keep the coal ones online. You need to keep the natural gas. You build the new natural gas. And if you want to add the wind and solar that's not efficient, go right ahead. You'll lose money, but do it. You have to be able to do this, but you have to permit that. And as you know, from a pipeline side, permitting is not fun, but it's very, very hard to permit stuff and then get this tied in. And then I would say the other piece of that is, how much does it cost, right? How much does your electricity cost? I mean, in Colorado, my bill is 3 times what it was pre-COVID. I mean, it's unbearable, the rates that Xcel is charging folks in Colorado. And that's all because they're passing off, at $2.60 gas. A couple weeks ago, I was at $1 and change. The pass through, the deflation you have on natural gas, people should be picking up their utility bills and seeing a lower price. They are not. Because utility companies, as you've seen in the stock market, they're ripping. Utility companies are passing through these rate increases largely for their renewables. They're passing it on, especially Xcel, on the rate for natural gas. They're passing it off to the consumer. And it's really, really expensive. So we are in an untenable situation for electricity, and it will break.
So I'd like to throw you a curveball. Jake, completely change the subject back to what we were talking about.
Okay, please do.
Okay, this is a curveball. I'm going to test your ability your abilities here. Okay, so a lot of the infrastructure that's been built out over the last 10 years, whether it's in the Bakken, whether it's in the DJ, whether it's in the Permian, those were built with original contracts. And I think a lot of the audience will understand, the original contracts are generally not the same as, longer term contracts. The pipeline operator has to charge a little bit more upfront to get the capital back, but longer term they reprice. A lot of the and all that stuff is driven by differentials. So this is back to differentials.
Right.
We're starting to see pretty close the end of the expiration of some of these longer term contracts, and the differentials are already starting to appear. And I think the most telling one is some of the original Dakota Access contracts are about to expire. We've already seen the differentials go from a positive $2 in basin to minus $3 to $3.5. Have you heard from any producers is that alarming to producers? Is that signaling to producers that they need to recontract? What from a producer standpoint, what is their perspective?
So I have not, lately, I'll be completely honest, I haven't talked to any producer that said, oh my gosh, I'm concerned about a $3 differential in the Bakken. However, that being said, at $80 oil, they're not going to be that concerned. Now, if oil prices is 60, 100%. They're going to start getting, the lower the prices. So the higher the prices, the less concerned they're going to be. The lower the prices, the more concerned they're going to be. Now, I would say right now, it's probably just somebody, it's not, if they're not concerned, it's just not quite on their radar. And it needs to be elevated to say, hey, we now have these, we're looking at potentially a $4 differential, and we need to solve for this. So it's going to grow. If it's just now happening and things are rolling off and those just are appearing, then they're going to say, oh, crap, well, there's that $4 I missed. And low natural gas prices matter for that, right? If everything's running and humming, you can take a hit somewhere. But if you're taking that hit on net gas prices and you have very, very low to negative net gas prices, additional hit on your differentials is going to be a problem. So I would say it's probably just coming to the radar of a lot of folks, and they're going to have to be rethinking about this. Look, and if they can also say, okay, well, I can get rid of that differential and I can sign a contract, why not? If I know what my production profile is going to be and I'm investing for long term, this is what I'm doing. If they're, with a lot of privates, they may not want to do that. They'll say, I'll take the few dollar hit and I'm going to run with this because maybe I don't want to be locked in. I think we're a little past like where we're at in the game of, do we want to lock in? Do we not want to lock in? If you give the guy a deal, I think they're going to lock in. Save money or not save money. I think it's going to be relatively simple, but $3 isn't going to be enough to move the needle at $80 oil.
Okay, and you did very well. Thank you.
Okay, you're welcome.
Over to you, Andy.
We're about out of time. This is great. For the audience, Trisha is a prolific commentator online. You can see her at Twitter, on PetroNerds YouTube site. I think you're active on LinkedIn, and of course the website. This has been great, Trisha. These insights. Look forward to continuing to talk to you. First, want to thank Natalie Webb and Merritt Allen for their help making this happen. For our expert interviewer, Tad True. And then finally, Trisha, thank you for joining us.
Absolutely. Thank you guys for having me. I appreciate it.
Thanks, everybody. Have a good weekend. Take care.
Thank you. Bye.
Thank you all.